welcome. Today I have with me Rajesh Bhatia, CIO, ITI Mutual Fund, and our in-house expert Dhirendra Kumar joining us to discuss the launch of ITI Large and Mid Cap Fund. Welcome, gentlemen.
Thank you. Thank you.
Thank you.
Rajesh, let me come to you first. To begin with, can you explain the primary investment philosophy and strategy behind the ITI Large and Mid Cap Fund, and also how is it different from the funds that are already there in this segment in the market?
As a backdrop, let me tell you, our in-house view is that India is in a structural multi-year bull market, and you can see that getting reflected in the bull market that we are experiencing. It is the best kind of bull market that you can get. Look at the breadth of sectors which are participating, right? Almost everything is participating. Autos, banks, life insurance companies, general insurance companies, domestic pharma, power equipment, utilities, capital goods, NBFCs. It's a breadth. That's the best kind of bull market that you can get. We think it's having a very diversified portfolio in India, which reduces risk, but yet can effectively make you a very, very good return. So one is, as a backdrop, we believe India is in a fantastic bull market. As far as our large and mid-cap offering is concerned, we're bringing in enough offer quite a while, over a year actually, because we think this is the best time to actually bring a large and mid-cap fund. So today, we have, after the market has done so well, large cap valuations which are quite reasonable, I would say. On a 26 basis, financial year 26 basis, large caps are quoting at about 19 or 20 times. A 10-year average of Nifty valuations is about 17 times. I wouldn't call that very expensive, given the backdrop of the fastest growing economy in the world with 7.5 to 8% GDP and an earnings growth of 15% is concerned. So those are good numbers. And yet there is an opportunity. Like I said, India is in a fantastic bull market. We see mid caps as really going to be the power in the next few years. While India is the fastest growing story in the world, that story is captured more by mid cap and small cap. The earnings growth in the mid-cap and small-cap category is far more than the Nifty companies. So we think that there's an opportunity to get the stability of the large cap and actually power your portfolio with mid-cap. And that's why we have launched the large and mid-cap fund. Let me also tell you one more thing about large and mid-cap. In isolation, large cap or mid-cap, either have a certain risk-return metric. Captured by return versus standard deviation. The combination of large and mid-cap fund actually is the better risk-return metric captured by, again, like I said, returns relative to standard deviation of the fund. So it is far more consistent than a large cap or a mid-cap fund. So it is an opportune time because we think the valuation and the need to power your portfolio is appropriate. And like I said, the large and mid-cap category is best on a risk-return paradigm relative to large cap and mid cap alone.
All right. Now, given the fund's focus on large and mid cap stocks, how will you balance the allocation between these segments, and what is the criteria that will guide this allocation?
Sure. So with the large and mid cap category, we are covering 82% of India's market cap. That's a fantastic breadth of opportunities that you'll be incorporating into the fund. As a SEBI regulated allocation, the minimum allocation to large caps has to be 35% with a maximum of 65, and the minimum allocation to mid caps has to be 35 with a maximum of 65. So the minimum large cap and minimum mid cap is about 35-35. So 70% of your fund has to be captured within these two categories. That leaves us a leeway of 30% of the balance. That will depend upon how we see value, where do we see value, where do we see mispricing. The secret to investing is really finding where is the mispricing in the market and being ahead of the market on that. So that is really where our stock picking focus of the fund really comes, and we will figure out where that mispricing is and allocate the fund accordingly.
Okay, moving on. Can you explain what are the key factors you consider when selecting mid-cap stocks, particularly for this fund, and how do you assess their potential to transition into the large-cap stocks?
So, by the way, the mid-cap to large-cap transition has been happening in India. There are several companies which have migrated from a mid-cap to a large-cap category. But if you look at the case of, let us say, where India is, there are a lot of businesses which are small in nature, but they deserve to be much larger, right? We are not recommending stocks in these sectors, but I'm just saying, let us say that defense sector, electronic manufacturing services sector, capital good and capital equipment sector, right? So there are so many of these businesses which deserve the real estate sector, right? It's such a large sector otherwise in any part of the world, but there are a lot of mid-cap companies still in the real estate sector. So there are the targeted addressable market of each of these categories is going to become much larger than where we are today. So by that definition itself, a lot of mid-cap companies will transition to large-cap companies. And like I pointed out, the core philosophy of our fund is finding mispriced stocks, do stock picking. One of the criteria for looking for stocks is find companies which are gaining market share in their respective category. If you find a company which is gaining market share in the respective category, you've found a winning company. So to answer your question, that's the framework that we'll adopt as you move forward.
All right, but mid-caps, the category itself is, there are inherent risks associated with them. So how do you plan to manage them, especially in such volatile market conditions?
So we are a long-only fund. Long-only funds cannot eliminate all the risk associated with equity markets. Having said that, this is the appropriate balance, right? What I'm talking about is large cap where there is value, and we see fairly limited downside, especially if you elongate the period of time, right? Then you have mid cap. Yes, there can be volatility associated with mid caps, given how well they've done already. But there's also a multi-year opportunity in some of these companies to kind of create wealth in the medium to long term. So we think that combination is extremely attractive. In the shorter term, there can be volatility, but like I pointed out, our belief is India is in a multi-year bull market. We think we will be able to offer value in the large cap and mid cap fund to our investors as you move forward.
All right, Dhirendra, moving on to you. From a historical perspective, how have large and mid-cap funds navigated market cycles so far, and what lessons can investors learn from these trends?
The large and mid-cap category is the result of the SEBI classification system. There wasn't a very precise large and mid-cap fund. There were funds which were conducting themselves as large and mid-cap funds. But that apart, I think, at value research, we look at, funds broadly into three categories. One is that, something which should be mainstream, a segment of the, kind of funds which will give you, which should be core of your portfolio, something which is, which is able to give you participation in the market in a very meaningful manner. We are still a believer of, active fund management and dominantly. And this is where I think, the large and mid-cap category, the flexi-cap category, or the multi-cap category, or the tax-saving funds, these are our mainstay. We still tell all our, first-time investors, all our naive investors that don't get into the sectoral funds, the thematic funds, and the small-cap fund. Though in good times, it looks good. So from that standpoint, ever since this reclassification happened, I think they have been able to build a case because the scope, you look for stability, but you don't invest in equity for stability. You invest in equity to optimize or maximize your return. And with that standpoint, I think, this really represents a very optimal combination of, stability as well as performance. So with that, and at the same time, at this point of time, I think it is looking very, interesting that something which will avoid small cap turns out to be a very tactical, a good omission at this point, because the universe is very large, and that could be a tricky segment of the market, which, only time will prove that, how tricky it was, or how, hindsight is always perfect. But right now, it is very difficult for somebody to ignore it.
Right. Rajesh, You mentioned about finding value and mispricing, but can you please elaborate on your process for building a portfolio and how do you ensure diversification while maintaining a high conviction in your selected stocks?
First of all, we have brought this large and mid-cap fund offering after quite a long time because it's the right time for a fund like this. It's an opportune time, given the opportunity and given the risk return. So that's one. Second of all, like I pointed out, the composition of the portfolio has many layers. But let me try and simplify it for you. The first layer is that we are very cognizant of what is there in the indexes, that the benchmark that we are tracking as far as large and mid cap is concerned, right? Second, we are also fairly cognizant of the sectoral composition of the large and mid cap benchmark, right? We try and make sure that one, we don't take very aggressive cash calls, which means you're more or less fully invested. Second, we make sure that we don't diverge too much from the sectoral sectoral weights, so that there is greater consistency in our fund performance. So what is our value add? We focus on stock picking. We want to find out where the best risk return within the sector is. And by the way, we see significant divergence within the sector of a winning company and a losing company. So there is great value to be added by the active share. And by the way, our active share in our funds is quite healthy. There is great value to be added by finding stocks in your portfolio. So that's one layer. The second layer of portfolio composition is to ensure we have classified companies into A, B, C, D category. With our A being the best in terms of profitability, consistency, governance, etc. Basically, they are good companies, and the D being the worst. We ensure from a risk management perspective that A and B are over 50% of our portfolio. So what that happens there, therefore, is we don't go into extremes. We have seen in the past, fund managers going 60 or 70% to D categories of companies. And while they may do well in the shorter term, that's not a good formula for the medium term. At ITI, we aspire to be consistent. So we make sure that that's again another composition of risk management that we adopt. Third is, you have a portion of the fund which is what I would call strategic, which is a multi-year opportunity fund, and the second portion of the portfolio which I would call tactical, which are probably 18 to 36 months in terms of capturing opportunities. So we have a portfolio of companies which are multi-year in nature, and those are hopefully buy and forget. And the second one is more tactical and more here and now kind of opportunities. So there are multiple layers to how we craft a portfolio, but I'll just give you some about that.
All right. And what role does macroeconomic analysis play in your investment decision process for this fund? And how do you incorporate in your stock selection and asset allocation?
So we don't forecast macroeconomic indicators, but fairly cognizant of it. So let us say if the US economy is going into a slowdown, we will be cognizant of the fact as to how it is going to impact IT services companies. If interest rates are going to go down, we will be aware of whether it impacts the asset side of banks, right, and benefits the liability side of NBFCs. If global commodities are going down, we will be aware as to how it impacts the commodity stocks in our portfolio and how it benefits, let us say, like an automobile company. So to that extent, we are just cognizant of macroeconomic indicators. We don't predict those indicators. Having said that, a top-down understanding of sectors does give us a reasonable sense of how to craft the portfolio as well.
All right. Is it possible for you to provide examples of specific sectors or themes you are currently favoring for this fund and your rationale behind those choices?
So, like I pointed out, I think India is in a fantastic bull market. And you can see it by the breadth of sectors which are participating. In my 30 years, I've never seen so many businesses look so attractive over the next 3, 5, 10 years. So we are in a very, very good economic environment and one of the best equity stories in the world to play. Given that breadth, As we speak today, we are fairly cognizant that this is a capital investment driven cycle. So there are a lot of opportunities within that: power, capital goods, defense, real estate. All these are basically capital investment driven cycle stocks. Telecom, life insurance, general insurance, private banks, domestic pharma. There are many sectors to choose. So we are bullish on all of these sectors as you move.
And how will you manage the fund's liquidity needs, especially given that mid-cap stocks are sometimes less liquid than the large ones?
So it's a problem we would love to have, but I don't think our size is going to be as large about liquidity. Like I said, it's a problem we would love to have as we move forward. But I think given the size of the fund that we are going to start with, it's not a short-term problem. It's not even going to be a medium-term problem for us. Unless you become far, far larger, 50,000 crores plus, I don't think that's a challenge for a fund like this.
And what is your approach to risk management within this fund? How do you ensure that, that the fund stays within your set risk parameters?
As an analyst, I think the first risk is finding the stocks and, making sure that you get your stock calls right. Making sure that you're in good businesses, governed well, and you're paying reasonable valuations. So I think from a bottom-up perspective, I would say that's the first thing of risk management. I've already outlined how we classify companies into A, B, C, D, and make sure that the quality of the portfolio is always at a good level. Third is we make sure that we have a fairly diversified portfolio, not only from a sector perspective, but also from a stock perspective. We hold usually about 40 to 60 companies on the minimum. So that diversification also helps to make sure that not, far more ideas govern the returns that emerge from our portfolio. And few stocks don't damage the returns or consistency of our performance.
Now, finally, how will you gauge the success of the fund over time? What are the benchmarks or metrics that you will use to assess performance?
So ITI Mutual Fund is a very, proactive manager. And we have all active funds under, our coverage. So clearly, as an active manager, we want to first beat the benchmark. Second, I think we are fairly cognizant that when you are bringing up an NFO, we have to make sure that the investor makes, over a period of time, equity type returns on an absolute basis as well. So when we start a fund, we have to make sure that over a period of time and be responsible that they make equity type returns. So those are the two criteria that I would bake in. One, that we actually generate an active return, which beats the benchmark. And second, there is adequacy of an equity return as you move forward.
All right, Dhirendra, final word from you. Considering the evolving market dynamics, how do you see the role of large and mid-cap funds in an investor's portfolio in the coming years?
A very important role. An important role, not because they have been able to build a strong case for themselves, just because I think, investing should be simple for common investor. So, and simplicity can be derived only if you have a vehicle which is getting you a very meaningful exposure across the market. And this is where I feel that, the flexi cap fund, which is my ideal, which is my choice, they are actually facing a constraint. Most of the flexi cap funds are turning out to be large cap funds, simply because of the scale they have achieved and, the mainstreaming of equity funds and keeping it simple. That is turning out to be disadvantages. About the large caps, it can't be mainstream. You can anchor a part of your portfolio, and there, you have a choice. I'm finding that, the large cap actively managed fund have lost the plot against the index. So if you have to really ride this India boom, which, Rajesh is emphasizing time and again, that we are in a multi-year bull, and I quite agree with it. With that in mind, I think, getting exposure and avoiding the nonsense, which is, I'm not saying that the small cap universe is nonsense. It is just too large. And we should not forget that, markets are cyclical. There are excesses after a couple of years of, a roaring bull market that we are in the middle of. And we will only get to know that what was actually not a good story only, with hindsight. and that will not leave a nice feeling. So with that in mind, I think this will be a very mainstream category for many investors. The definition of a universe, or the universe getting defined by SEBI, that these funds can't invest in more than in any stock beyond top 300. That is like actually setting the boundaries. So with that in mind, I think this is going to be very promising segment, or a kind of fund which it has not been in prominence. It is actually gaining prominence only after fund companies have exhausted the avenues of launching funds, achieving scale, and this is where I think it is going to be a very mainstream category, important for us, and it will be in our sharp focus for recommendations too.
All right, with that, time now for us to wrap up this chat. Thank you, Rajesh, for taking the time and speaking with us. Thank you, gentlemen.
Thank you.
Thank you.